Hi, welcome to today's video and thanks for joining me. Today we're going to be talking about the smartest investment mix for retirees right now. If you are nearing retirement or in retirement, this is a video you may want to pay attention to because I'm going to be sharing with you exactly how to manage your money during this period of time in the market. Now, over the last 5 years, we have had 3 market declines of more than 20%. It's been the worst period for bonds and unprecedented news articles that have shifted the market negative to positive and back to negative again. It's been kind of difficult to figure out how to manage your money. And as you've been approaching retirement and seeing markets hit all-time highs only to reverse their positions again is leading you to feel very uncomfortable and uncertain and uneasy about where to put your money. So in today's video, I'm going to be sharing with you exactly where you should be investing your money, how to develop that portfolio yourself. I encourage you to be with an advisor and to get some of their help as well. But by the end of today's video, you're going to know exactly what you should be doing with your portfolio as you are entering retirement. Okay, without further ado, let's get into this video. And again, put your comments below. I love reading your comments, and like and hit that subscribe button. Okay, I want you to focus sort of your attention around investing away from the 60-40 split. Many people have said 60-40 split is the best type, 60%, depending on your risk tolerance, 60% equity, 40% fixed income. It could be the other way around, 40-60, where you're 40% equity, 60% fixed income. But this is really around this go, slow go, and no go. I want you to think about that. I want you to consider building your portfolio not based off of opportunity, what you see in the market, but based off of the way that your spending phases are going to change over time. As you were living and working and had a paycheck, you weren't as concerned as you are now that you're retired because, well, after all, next week or every 2 weeks, you get another paycheck. And you could sort of, well, I've got money in my hand. I can either invest it in the market, take advantage of things. You can be a little bit more aggressive. Time was also on your side. But now that you're entering retirement, it's all pretty much up to you in terms of how much money you're going to have over your lifetime is based off of how you invest your money. And part of that goes into how much money you're going to be spending and when. So that's that go, slow go, and no go phase. So what I want you to consider is, let's build a portfolio around these phases of needs, if you will, okay? As opposed to just arbitrarily saying everybody should be a balanced investor or everybody should be in Canadian equity or US equity. Let's be a little bit more tactile in our approach to building a portfolio. Okay, so what are the 3 biggest risks to you right now? Well, it's volatility. This is a sequence of return risk. What happens to you when you're investing and the markets are going up and down, and especially as you are in retirement? The next one is inflation. This is the erosion of your purchasing power. You want to make sure that your money is still working for you and increasing over time, at least by the cost of inflation, at least as a minimum. And then we're going to look at the emotional or the behavioral impact of how you make decisions during times of volatility or during times of opportunity, that FOMO, fear of missing out. So we're going to be looking at not making bad decisions at the wrong time as well. So 2 things, right? So these are the 3 biggest risks. So let's talk about the first one. It's volatility risk. Now, volatility, if you look at the VIX, I'm not going to show that here, but the VIX, VIX, that's a measurement of the sentiment in the market of how nervous people are about the markets right now. And anytime the VIX is below 20, so if you look at a grading scale, anytime the VIX is below 20, people are really not that concerned. They see the economy doing well, the market is doing well. When the VIX goes over 20, that's when people start to feel kind of nervous about the market. It could be that the market is at an all-time high, which it is right now. It could be that the economy is shifted and there's high unemployment rate, or the economy is slowing. It could be just unsettling events around the world that are making people nervous, and the VIX climbs higher. So this is something that you could pay attention to see what the market is kind of laying out in front of us. And there's also your gut instinct, how you're feeling. You watch the news every day, which I don't think you should be doing. Watching the news every day, that tends to get people very nervous. But what happens to people during times of market volatility is they make decisions about their portfolios, selling, buying more, doing nothing. And so this is really important. But more importantly, when you're in retirement, this is the period of time where you're doing withdrawals, right? So prior to retirement, you're always adding money to your, it's that accumulation phase, we call it. So you're adding money to your portfolio during your working years. Now in retirement, you are doing withdrawals. So this is called sequence of returns. And this is sharing with you what happens when you experience different types of returns over a period of time, and what happens to your portfolio. So there are there's really one return. It's 4.8% over a 10-year period. And that middle line, that dark line you see there, that's your 4.8, same 4.8%. And someone's portfolio that is about $500,000 grows to $537,000. But what happens if you receive 2 negative returns in your first 2 years, but still averaged 4.8% over a 10-year period? You would end up having $472,000, less than the $537,000. So those 2 negative returns in the first 2 years were deeply impactful on your portfolio. But if you had a portfolio where the first 2 years were gains to your portfolio and still averaged 4.8% over the 10-year period, you had the highest portfolio balance of 586%. This is called sequence of returns, and this is what we're trying to do, is to be very mindful, because it's one of the biggest impacting things on your portfolio. And I'm going to share with you how to mitigate sequence of returns. So when you look at the S&P 500 or the S&P TSX of the Toronto stock market, the S&P 500 is the US stock market. And so when you look at these indexes, and you see this chart below or to the side here, this is the NASDAQ in purple, the blue is the S&P 500, the orange is the Dow Jones, and the light blue, the one at the very bottom of the page, is the Toronto stock market. And when you look at long-term, all these advisors tell you, think long-term, think long-term. And it's true. Think long-term. You retire today, you have another 30 years at least in front of you. That's a long period of time, so you should be thinking long-term with your portfolio. But you also have to be thinking short-term with your portfolio. Because if you look at the long-term return of, let's say, the S&P 500, it's going to be 9-10% long-term. But your money has to be working long-term, and it has to be near-term, because you need the money today, every month, to pay the bills, right? So your portfolio has to be invested in such a way that it satisfies your near-term need and also satisfies your long-term need to grow your money ahead of inflation, so that you're still going to have money later on in life, right? You see that yellow square in the middle of this 5-year chart? This was between 2022 to 2024, and all 3 indices took 2 years for them to reach their high. So in 2022 was the high, the peak of all the markets, and it took 2 years for them to get back to their peak again. So in this case, the average bear market is about 2 years. So if you are investing your money today and you are examining your own portfolios, but you are full on US equities right now, for instance, understand that if we go into a bear market, it could be a month, it could be 2 months, but it could last 2 years. And as a retiree, you don't have 2 years of time to wait for your money to recover. So you need to have a different way to invest your money. So what is that way? So this is really volatility, is what we're talking about. So what I want you to think about is not something you've heard before. I think you probably haven't heard this before. You'll hear advisors say, well, you should put 2 years. I even have in my videos about the Cashwood strategy, or just putting money, the 3 bucket rule, where you put money aside for 1 year, 2 years, if you feel like that is enough volatility. Well, in this particular case, we're going to examine 5 years, right? This is actually a really interesting way to manage your money. Now, this really only works well if you've got more than the average person to invest. If you don't, if you're retiring and you have pretty close to having enough money to retire, then you may not want to do this because it's putting 5 years of cash aside in slower returns, but more stable, more secure, more safe. So it may not make sense if you've got a low dollar amount. If you've got maybe say 700, 800,000 to $1 million, then it starts to make sense, okay? So what are we going to do? We're going to look at a 25-75 split. So you're going to have 25% of your money in relatively safe investments, lower return, very, very neutral as it relates to the way it would affect it in a market, say a volatile market. So what are these kinds of things? There's bonds, money market, GICs, and when you look at those, so the bonds, for instance, the bonds are going to not be as volatile as an equity, right? You're going to see those things are very, very slow, turtle kind of movements. Money market, very, very low risk there. The only time I've seen money market go negative was in the 2008 world crisis. And then GICs, well, GICs, the only risk to a GIC is your reinvestment risk. When your GIC matures and the rate is not as good, then you're investing down into the market. So just really just your reinvestment risk. So what I want you to consider is looking at your investments this way. Now, don't despair. I laughed this couple. Don't despair that it's low return, because your return isn't what you're going here for, right? You're not trying to get growth with this 5-year period. You're trying to protect your assets. And so don't despair about this 5-year period of low returns, because it's only 25% of your portfolio anyway. Okay, so I'm going to set this up from a point of view of understanding how much money. So if you're a couple today and let's say you got average CPP and OAS, your combined CPP and OAS might be about $35,000 per year. And let's say you had a need of $85,000 of total income for the year to be able to afford your lifestyle. Does that sound pretty close to what you might be experiencing in your life? And so what are you going to need? $50,000 you're going to need from your investment accounts. Pretty simple, pretty straightforward, right? Okay, so when you look at it like this, if you have $1 million, I'm just going to say $1 million, don't be discouraged that you say, who has $1 million portfolios? It's just the math is easier for us to understand the concept, okay? If you have $1 million portfolio, $50,000 per year is what you need from your portfolio, and you're going to set aside 5 years. So that's represented by the first 5 green columns that you see there. 5 years at $50,000, that's $250,000. The $50,000 is going to be invested. Now, the $250,000 can be invested in laddered GICs. You can have them laddered bonds. It's really you have some in cash, for instance. Within each one of those years, you could have different kinds of timelines in how you invest your money. Some of it may be on a quarterly basis just in cash. The next quarter is maybe a bond. Then you've got a GIC maturing in 6 months. So there's different ways to invest that $50,000. But essentially, that orange line that you see going through there is the stock market. So when you took your $50,000, your $250,000, and there's a period of time, lucky for you that you ended up doing this strategy, because the market kind of went sideways on you and then finally started to recover, kind of like a bear market. So that $50,000 really didn't lose much money at all. In fact, that way you protected it. The next 5 years comes along and you're older and maybe your expenses have changed. Plus, your CVP and your old age security are also bigger, right? They go up with inflation. So now you only, let's say, need $35,000 from your portfolio. Maybe I'm just showing you sort of like phases of income. So maybe it's only $35,000 that you need out of your portfolio, not 50. So you put 5 years aside, $35,000 each. Same kind of principle. That leaves 75% of your money in equities. And you'd say, Well, I'm not really keen on having 75% of my money in equities. And ordinarily, someone would say, or an advisor would say, I agree with you. Maybe you shouldn't be in 75% in equities. It also depends on what kind of equities you're in as well. But on the other flip side of that, you could say you also have 5 years of cash reserves in solid investments that, should the market shift on you, you have no worries about continuing your lifestyle over that 5-year period because it's already there, funded, ready to go. So it leaves you in a position to be very, very mindful about, okay, what could I do with the money that I've got in that 75%? How could I be investing my money differently than I would have done previously? I see a lot of people that might do 60-40, and so they have a very kind of low return profile, and they're maybe a little too conservative. But in this case, now you could be a little bit more creative about how you're going to invest that 75%, because now you can think about which investments aren't that speculative but maybe hit the right marks for you, and they can be all over in terms of different sectors. And so I would get to with your advisor and talk about what kind of portfolio would work well over this year, next year. So not that anybody really truly knows which companies are going to do well, but we do have some sense of what's happening over the 3 months, 6 months, even a year. We have a good sense of what to expect in the equity markets and bond markets. So it's worthwhile having this conversation with your advisor, saying, what do you think of this strategy? Is this something that we could work on? Okay, the next one is inflation risk. Now, you all know inflation in 2001 was something that we had to deal with, and for many of us, we're still having to deal with different costs in the grocery store. You can see this is the Canada inflation rate since 2016. This is this magic number that the government's trying to get to, 2%, maybe 2.5%. And you can see 2020, things went down, the inflation rate, and then it went skyrocketing high, right? And we knew why. I'm not going to say the name because I don't want this video banned, but we know why there was a disruption in the supply chain, and shortage of things causes inflation to go high. And so you saw that right there. Now inflation seems to be coming down on some areas, and still other areas of the economy, the inflation is still quite high. But what you'll notice on the right-hand side is this is the projection for inflation in 2026, and it's an increase. So right now we had a decrease of interest rates. There's speculation that we're going to get another decrease in interest rates. But my feeling is that we'll get increases in interest rates at some point in 2026, because inflation is looks like it's going to be going up again. Okay, when we are doing your plan, you are looking at part of a plan right now. I'm not showing you the full thing because you don't need to see everything, but this is the part that really matters. When we're doing your plan, we're putting in your expenses. You see that middle column, that whole section called expenses, and we have your real expense. That's how much money you actually physically need in your hand today. The nominal is the same amount but adjusted for inflation. So you see that when we're talking about inflation, we have to build inflation into your retirement plan. So it doesn't, inflation is eroding your purchasing power. We want to make sure that your purchasing power is going up at least by inflation. So in 2028, when this couple is 63, $82,000 is actually $88,000. So we have to make sure they have purchasing power of $88,000. Also, that $15,000 travel goal that they had in 2025, in 2028 it's actually $16,500 now. So we're making sure that all of these expenses that you have goals for yourself, we're adjusting them for inflation, right? So that you're always making sure that your purchasing power is being maintained because of inflation. This happens in every single plan, and you'll see it in your plan when we do your plan. Okay, emotional risk, we're on the last one, then we're done. Emotional risk is not, everybody running around scared and nervous. That's typically not what we're talking about. What we're talking about is having a good long memory of the markets and how that might affect you going forward. if you look at this is from 1997, 2000, but the big ones, right? The dot-com, the global financial crisis, and then that event that happened in 2020. I was working in this business during all of those events, and I saw some crazy, wild things happening, as you did as an investor. I also was an investor. And in each case, the market went down and went back up again. Now, it took a long time, both in the dot-com part and the global financial crisis. The dot-com took a long time for money to come back. It took about 5 years, more than 5 years for money to come back. We called that the last decade, basically. The global financial crisis took 5 years for your money to come back from the high to the next high. It took 5 years. And this last event didn't take long at all, because the government spent their way out of that. And you saw your money, your home prices and your investment accounts all skyrocket. And here we are today. But you're mindful of that event, right? You're mindful of when you're looking at today, when you see the markets are all really at the highest point, you're saying, I remember when we were at highs and then this sudden drop. So you have this emotional bias to the markets. You're wondering when's the next drop going to happen. So how do you figure out what to do here? Well, what you want to do is very different from the first example that I showed you when we went and we were talking about how to invest your money. This is different than that. This similar but different. What you want to do is you want to look for negative correlated investments. So when something is going up, the other one's going down. When something is going down, the other one's going up. Absolute negative correlation. You do not want correlated investments. I've said in other videos, you want to have 15 uncorrelated income streams in your portfolio. That's Ray Dalio, by the way. I'm quoting him. He's one of the most successful investment managers in the United States. So what can give you a negative correlated investment? Well, things like bonds, especially long-term bonds, gold and precious metals. Right now we see the stock market skyrocketing, and gold has gone up. But if you see the market drop, gold is going to go up like a rocket. So if the market drops, gold and precious metals are going to skyrocket. If you go into inverse ETF portfolios, these things do the opposite. So when the market is dropping, the stock market is dropping, these ETFs are going up. So what could you do here? You could take some of your money and you could specifically position them into investments so that it's kind of like a hedge against what's going on. So that if the market does drop suddenly, the other part of your investments are rising, that would sort of smooth out the return, so that this big negative return is being smoothed out by an increase in these other types of investments. Talk to your advisor, figure out what you could be investing. Know that when you do this, as the markets are going up, these investments are going to really not perform well, and you're going to have to eat that for a little while. But it's because you are hedging your bet against a sudden correction in the market. And it's not a bad thing to do with some of your money to say, look, I'm just worried about the markets. And when markets are at an all-time high, is it being fearful of saying, I think I'm just going to take some of my money and put it in safer investments? I don't think it's fearful. I don't think, the sky is falling kind of concept. You're just saying, hey, you know what? I don't need to be that preoccupied with growth. Especially, this give you some insight, when you go back to your plan, this is why I say get a plan done, because this will really help you. When we do your plan, we're saying specific rate of return to grow your money, and you'll have this amount of money throughout your lifetime. If your plan is actually if your money is actually ahead of the plan, that means that your plan was working at a lower rate of return, but you have more money than what the plan says. That means you don't need to be chasing these big returns. That means you don't need to be invested in an all-time high market. You can actually take some of that money out and go into safer investments, like in the first example, or you can go into negative correlation because you're really concerned that we're going to have a reversal of the market. That's what this means. Okay. Wow. That was another good video. I hope you enjoyed. Remember to like and share this video. Make this available to your friends, and hit that like button. I've got another question for you. So as you move into your retirement, what scares you the most about the stock market? I'd love to see your comments about this. I have a feeling that we're going to get a lot of really great answers. Again, it was really good to see you in this video as well, and I look forward to seeing you in the next video. Thanks, and be well.